As investors and Wall Street both focus on earnings and especially earnings per share, Bob Pisani explains why those critical numbers sometimes aren't all they're cracked up to be.
One thing that's been overlooked this earnings season is the big influence buybacks have had on those earnings. Buybacks usually lead to a reduction in the share count outstanding, and that translates into higher earnings. That's why investors like buybacks so much. And the buyback craze continues into this quarter. 20% of the S&P 500 have reduced their share count by at least 4% in each of the last 5 quarters. That's a lot. One shining example is Apple, which has reduced its share count by more than 10% in just the last 2 years, meaning earnings are 10% higher than 2 years ago, all other things being equal. That's an increase in earnings independent of any sales increase, independent of cost reductions. You see why investors love buybacks? Many other companies have been aggressively buying back shares as well in the last year. They include Bed Bath & Beyond, Yahoo, Sherwin-Williams, Harley-Davidson, AutoZone. Some companies have become buyback monsters. This is my phrase. They're aggressively buying back their stock year after year. One good example is IBM. They have reduced their share count by 22% in the last 5 years. Is there a downside to buybacks? Yes, there is. Many investors want companies to put that same money to work growing the business by increasing sales or innovating with new products. So here's the bottom line. Use financial engineering like buybacks to increase earnings is fine, but it's no substitute for growing the company. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.